This is Ken Finnan from Capital Advantage Tutoring. I couldn't even think of my name. It's my job to get you past the Series 7 exam. So today I got a request on TikTok. I have a TikTok account. That's crazy. I'm old, but I have one. And they asked about the yield curve. So I'm going to talk about the yield curve. So take a seat and let's go. So when we look at a yield curve, we look at the axis, right? So the left side has all the percentages going up. And then on the right side, the bottom, X or Y axis, whatever you want to call it, is the years. So if I'm going to borrow money for a short amount of time, the rate's going to be lower, less risk. The longer I borrow the money, in a normal situation, the longer I borrow money for, the greater the risk, the greater I have to pay you. So a normal yield curve would look like this. Start low and go up, and then, maybe kind of flatten out a little bit, but that would be a normal yield curve, okay? So that's the normal way. That means, and that also means, since the Federal Reserve covers short-term rates, the Fed has been lowering rates. They've been pushing them down. They do the discount rate, and they impact the Fed funds rate. So they push it down, and that pushes those rates down, and that makes a steepening curve. The more they push it down, the steeper the curves get, the more ascending it is. Now, when we talk about the Federal Reserve, they're pushing rates around. So I always say this long and low, right? If you've probably heard me say that long-term bonds move more than short-term bonds. That's price-wise. It's totally opposite with rates because these are rates. These are yields, okay? These are the yields of the different lengths of bonds. So the yields move quicker on short-term and high coupon. It's just the opposite of prices. Now, that means the Fed has been going down, and now that also means we're, maybe not such a good economy. They've been lowering rates, and now we're heading into a better one at some point. Because if you see this, it's a normal curve, that means the Fed has been lowering rates. What are they going to do in the future? They're probably going to start raising rates. See if I can do this right. So then what is the Fed going to do? They're going to start raising rates, pushing these rates up, and it's going to flatten, boom, and it becomes inverted. Let me bring it down a little bit to make it look a little more clear. But this was what an inverted curve looks like. That means the Fed has been raising rates. They're tightening. Good economy. They've been raising rates, and that means the short-term rates move faster. So the short-term rates, and then eventually the long-term ones would eventually go back to, well, I can't do this. Eventually the long-term one would get above there, and the whole rates go up. That's what happens when the Fed raises rates. It goes inverted, and then it becomes normal again, which the longer rates finally catching up. Now, the next thing some people talk about is the yield spread. So the yield spread is the difference between two different types of bonds, normally treasuries and corporate bonds. That's the way I'm going to teach it. So normally treasuries have a lower rate than corporates because treasuries don't have default risk, corporates do. So the yield will always be higher on a corporate. Now, what happens is they look at the difference between the two, the spread between these two. If it narrows, okay, so if it narrows, okay, if the spreads start narrowing, then that means people are buying bonds, pushing the price up, buying corporate bonds, pushing the price up, and the yields drop. So it's going to drop. And that also means they're going to be selling the treasury to do it. So the treasury prices will drop, raising the rates. The yields are going up. So that's a narrowing spread. So that's when it's narrowing. That's a sign of a better economy. Now, the other side is if the spreads start widening, okay? Widening means that people are selling the corporates, causing the price to go down and the yields go up, and buying the treasuries, causing the price to go up and the yields go down. It's widening. The way I remember it is this is a sign of a bad economy. So I always remember that you have to open your arms wider to get more stuff in a bad economy. There's other things that you can look at too, but that's what they're talking about, the yield spread. If you like what I'm doing, check me out on YouTube. Please like, subscribe, share this stuff if you think it's helping. Let me know if you have anything else you guys want me to talk about. Let's go.